Hi, I hope you all are doing really well. This is Ritika and we are doing reading 30th of corporate issuers called Cost of Capital. We are beginning with a new reading called Cost of Capital, and this is reading number 30th of corporate issuers. So before we begin, what is cost of capital? The cost of capital is the minimum return that a company must earn on all its investment projects in order to satisfy various categories of investors who have provided capital to the company, such as shareholders, debenture holders, bond holders, term loan providers, etc. And if the company is not able to earn the minimum required return for each of such investors, they would be tempted to pull out their funds from the company, and the company may suffer a loss in its reputation and value. And in this chapter, we'll discuss different costs attached with their respective capital sources. So let's start with the first LOS. The LOS-A requires us to calculate and interpret the weighted average cost of capital or WACC of a company. So what is WACC or the weighted average cost of capital? The weighted average cost of capital is the average rate of return that a company earns for all its investors. It is the cost of capital that is weighted proportionately for each category of capital. So what you basically do here is you calculate the total returns on capital of a company and weigh them proportionately to each source, that is equity, loans, etc. WACC is also sometimes called as the marginal cost of capital, as it is the additional cost that a company incurs for additional capital. And this is how the capital structure of a company looks like. It mostly comprises of the debt capital and equity. And equity could be of two types, preferential shares and common equity. Each of these components of capital has its own cost. Whenever a firm wants to make a new investment in a capital project, it requires new capital. So to raise additional funds, the firm would need additional cost. This additional cost is referred to as marginal cost of capital. This marginal cost of capital is different from the cost of capital of the entire company. It is the required rate of return for the average risk on this particular investment. By doing so, we can easily identify and adjust the projects which are riskier in nature in comparison to the average risk of the whole company. And so this reflects their respective cost more accurately. Moving on, how do we calculate the cost of capital of a company? The calculation of the cost of capital is a two-step process. We first calculate the marginal cost of each component of capital and then weigh each of such marginal cost. So this is the equation for calculation of WACC. Here, WD is the proportion of debt in the company, RD is the before tax marginal cost of debt, T is the company's marginal tax rate, WP is the proportion of preferred stock, and RP the marginal cost of preferred stock. WE is the proportion of equity that the company uses, and RE is the marginal cost of equity. Now we'll take an example so that you can understand the concept with better clarity. Consider a company XYZ Limited with the capital structure like this. So you have debt, preference share and common shares, each with a weight of 40, 10 and 50% and a cost of 8, 9 and 12%. Assume that a tax rate of 30% is applicable to the company, and now we are supposed to calculate the weighted average cost of capital for this company. So we can calculate the WACC of the company using this formula. So we take the cost of debt, which is 8%, multiply it by its weight, which is 40%, and adjust the same for the impact of tax, which is 1 minus 0.30, plus the cost of preference share, which is 9%, multiplied by its weight, which is 10%, plus the cost of common shares, which is 12%, multiplied by its weight, which is 50%. When we solve this, we get the value of WACC at 9.14%. You can always pause and do the calculations for yourselves. Now this figure of 9.14% means that if XYZ Limited wants to finance a new project, it will discount the cash flows from such project at an average cost of 9.14%, assuming that it would be financed in the same ratio as that of the existing capital structure, which is 40% debt, 10% preference shares and 50% common equity. Now let's do a few questions kind of like those that are asked in the examinations. The first question says, the cost of equity is equal to the A. Expected market return, B. Rate of return required by the stockholders, or C. The cost of retained earnings plus dividends. Well, the expected market return is the return on the market which is earned by all the companies in the industry. So option A is not correct. Then B. The rate of return required by the stockholders is the actual rate of return on equity. So option B is correct. Now moving on to the next question, it says, using the dividend discount model, what is the cost of equity capital for Jeller Mining if the company will pay dividend of Canadian dollars 2.30 next year, has a payout ratio of 30%, a return on equity of 15%, and a stock price of Canadian dollars 45. And you are given the options. I know we are discussing WACC here, but it is important to understand these calculations also because we are calculating the cost of equity, which is a part of WACC. So using this formula, that is DDM formula, we'll calculate the expected growth, which is value of G. So we have the value of P, which is 45, D1 is 2.30, R as 15%. So if we solve this equation, we get 45 into 0.15 minus G equal to 2.30. Solving this, we get the value of G, which is 0.9889. Now using the expected dividends 1 year hence, we'll calculate the total return on equity. Now the expected dividend after 1 year is 2.30 and it is 30% of the total return on equity. Therefore, the total return on equity is 2.30 divided by 30%, which is 7.6667. Now let's say that the current return on equity is X. So X plus the value of growth, that is X into 1 plus 0.9889 equals 7.6667. So X is 7.6667 divided by 1.9889. We get X that equals 6.9767. And what percent is it of the current market price of 45? It approximately equals option C, that is 15.61%. Moving over to the next question. A financial analyst at Bucky Barnes Company Limited wants to compute the company's weighted average cost of capital using the dividend discount model. We have the following data: before tax cost of debt, tax rate, target debt to equity ratio, stock price, next year's dividend, and estimated growth rate. And we have to calculate Bucky's WACC. So here what we'll do is calculate the cost of equity using this DDM equation. So we have a stock price of $30, which equals D1, that is $1.50, divided by expected return on equity minus growth, which is 7%. We'll solve this for the value of K. So we have K minus 0.07 equal to 1.50 divided by 30. So we have the value of K, which is 12%. Now we'll calculate the weights of equity and debt. The debt equity ratio is 0.8033. So debt is 0.8033 times E. The combined weight of debt and equity is 1. Therefore, E plus 0.8033 times E is 1. Solving for E, we have E equal to 1 divided by 1 plus 0.8033. So E is 55.45%, and thus the weight of debt would be 44.55%. Now we have the cost and weights of both debt and equity, and we can calculate WACC using the same. So WACC is cost of equity, that is 12%, times its weight, which is 55.45%, plus the cost of debt, that is 8%, minus the effect of tax. So we multiply this by 1 minus 0.40 and multiply this by its weight, which is 44.55%. When we solve this, we get the value of WACC, which is 8.79%, and it is closest to option B, that is 9%. Finally, moving to the last question, it says, the gearing company has an after-tax cost of debt of 4%, a cost of preferred stock of 8%, and a cost of equity capital of 10%, and the weighted average cost of capital is 7%. Gearing intends to maintain its current capital structure as it raises the additional capital. In making its capital budgeting decisions for the average risk project, the relevant cost of capital is A 4%, B 7%, or C 8%. So if the company is planning to have the same capital structure, the relevant cost of capital would be same as WACC, which is 7%. So option B is correct. That was LOS A. If you have any questions, contact us through our website ProCFA.com. Also check out the website for the latest study notes and question banks. Take care and practice as much as you can.